don't look at individual loan. You just take that all the loans in total, whatever loans that you have in total, then you make a provision on it. I mean, you just take a percentage. Like if expected is 1%, just put 1% on the total. So if you have 100 million loans, just take 1% of 100 million, which is 1 million. Set aside profit. That's general provision, right? Means there's no reference to any particular loan. It's in total, right? Then on top of that, you must also make specific provision. Now, what is specific provision? Specific provision means you have identified the loan that have a problem, right? Now you are not looking at that overall. You look at individual loan one by one. Then you spotted, this loan has some problems. So if there's a problem, then we have to make a certain specific provision. Yeah, right? Okay. So means individually. So specific provision is relating to individual loan. General provision is overall in total without looking at individual loans, right? So you have to make set both general and specific provision. Yeah, all right. But when it comes to specific loan provision, right? When do we make the provision? When, right? So generally, before you make the provision, there are certain classification, right? Now, what is being shown in the book is the US classification, which I believe part of it is also adopted in Malaysia, right? So what they say is when you have a loan, individual loan, you have to classify them into the following category, depending on which one is appropriate. For example, is the loan a standard loan, or specially mentioned loan, or substandard loan, doubtful loan, or loan loss? Now, what do you mean by that? Right? It means that, look, standard loans means loans okay, no problem, standard, just a loan. So if it's standard loan, everything going fine, no provision required, no specific provision required. No need, no need, because everything is okay. Yeah. Then they have specially mentioned loan. What is specially mentioned? Means the loan is still okay, but there are something dropping out. Okay? But the loan still okay. They're still making payment, right? But there are some issues that the bank may be concerned about, right? Those talks actually mentioned loans. Now, basically, this type of loans, you don't need to make any provision. But it's up to your bank. If your bank thinks that the specially mentioned issues is critical, you may want to set aside, right? Up to you. It's a policy, no? Prudential policy, right? If you want to be prudent, you set aside some money. You don't, up to you, right? No issue. But the meaning that is substandard, something is not right. What is substandard? Substandard, it could be like maybe the loan has not been serviced for 2 months or 3 months, example, right? Means interest are not paid for 2 months. That got substandard loan. Yeah, right? And then doubtful loans, it can be something like more than 3 months, they have not paid, no action taken, nothing happens, still going back. More than 3 months, they become doubtful already. Doubtful means the chances of it getting default is getting higher and higher, right? Okay. Then loan loss, it could be like after 6 months or 1 year, no activities, doom, done. Then the whole loan is considered gone. Right? Then those loan loss, right? So basically, this three you have to make provision. Yeah? So what is the provision amount? Depends. Yeah, right? Depends. Okay. So your bank may have your own policies to follow, right? So these are the things that you need to look at, specific provision, right? Okay. So basically in exam, they may ask questions like what is the or what is this classification of standard or this loans means, right? So you have to explain in detail. Okay. So that is simple explanation. Yeah. So just understand the difference between general provision and specific provision. Under specific provision, there are various categories of specific provision. Yeah. I mean, how do you classify those loans individually? Yeah. Okay. So just to summarize, it just says that every bank should have some amount of expected loss. Means something that you expect to lose when you give out loans. Okay. So in computation, we call it the mean loss, average mean loss, not average figure, right? Mean loss. Okay. Right. And how to so-called what precaution that we take by setting aside profit in the form of provisioning, right? It can be general provision on the overall portfolio or specific provision on individual loans. Yeah. Okay. Now, the next type of loss is called unexpected loss. Unexpected. Unexpected means something not what you expect and is out of the ordinary course of business. What it means that this is something that you did not expect to happen. You don't know when it will happen, and if it happens, you don't know how much it will be. Right? Something you never expect. That's what unexpected loss. Right? So unexpected loss is basically the standard deviation. Standard deviation is called unexpected loss. Yeah. Okay. Right. So anything above the mean is called standard deviation. Yeah. Okay. For example, the case that some of this diagram they show you this side, right? But basically, just to explain to you, is that this is the mean. This is the mean, right? Mean means expected loss, right? So this is the SD, right? So from here to here is the unexpected loss, right? Or you want to put the other side lah. Loss will be this unexpected loss, right? Standard deviation. So from here to here is unexpected loss. Yeah. Okay. So it's beyond what you expected. Okay. And unexpected means something you didn't expect, right? You know when it happened. If when it happened, how much? If it happened, how much you do, right? So in that case, now also remember, it's not something that will happen in the ordinary course of business. Okay. Unlike expected loss, actually it's part of it, part of the ordinary course of business. So what you can do is, all you need to do is set aside some profit to cater for it. If it happens, you can use those profit that you set aside to cover the losses. If it doesn't happen, the profit can be written back as profit. Means the provision can be written back as profit and use it for some other things. As simple as that. But how about an unexpected loss? So, with something that you don't know whether it happened or not, but when it happened, it can hit you very badly, right? But how much is that? We also don't know, right? So what we can do is we can use what we call the value at risk measure, or in this case, use standard deviation to calculate it, right? So once we have calculated, of course, like some of you say, we actually don't bother how you calculate. We just work on it, given the number, right? We work out. So if you are using a model to work out the unexpected loss, once you have determined as unexpected loss, what will you do? How do you provide for it? So the difference is, in as unexpected loss, you provide capital. Capital means you cannot use your profit to set aside. You must come out with money from your own pocket to provide for it. Yeah, means the bank now must raise its capital to provide for this unexpected loss. Yeah, right? So unexpected can be expensive. Why? Because it comes from the capital of the company, not from the profit. Capital means you must take out new money to put into the business, right? Okay. Whereas expected means provision means you take from your profit. Means you don't have to take money out from your pocket. You just take from where you earn. You just set aside something. Just like the salary, you get a salary, you set aside a salary aside to cater for it. But in this case, unexpected loss, no. You cannot use a salary to provide. You have to come up with your own savings. Bring it out your own money to provide for it. That can be quite damaging to the bank. Damaging in the sense that costly to the bank. Yeah. Okay. So just to let you know what it means is unexpected loss, right? It's something you don't expect it happen, but you have to provide for it in the form of capital, right? Now, how much is this unexpected loss? We don't know, right? Nobody knows. Like I told you just now, we don't know when it happen, how much it happen, by when it happen. But you are expected to provide for it. So if you're expected to provide for it, how do you calculate? How do you calculate? So, like I said just now, you have to calculate using value at risk, right? Value at risk. In calculating value at risk, how big is the loss will depend on two inputs. The time horizon means how long are you going to give the loan, and the confidence level. Remember, standard deviation, how confident you want yourself to be. The more confident, the higher the loss you provide. Means if you want to be very, very sure that you can withstand the loss, then you have to provide more capital, means to put in more capital to do it. That is how you calculate, right? Now, in exam, they're not going to ask you to calculate, but they just want you to know that in value at risk computation, you must decide on these two inputs, the time horizon and the confidence level. We will talk about this later. Yeah, right? We'll talk about this later. Okay, so just to wrap it up, basically what you need to know here is the difference between expected losses and unexpected losses, right? So expected losses, you make provision, right? It is part of the ordinary course of business, means every business, every bank should expect that loss to happen. Okay, so you just work on a certain amount, calculate it, set aside in profit. That's it, finish. But they're also called unexpected losses, which different bank will look at it differently, right? Because it is something that nobody will expect. You don't know when it will happen, how much it happen, how much, right? So you don't know. So it's just like a guesswork. Basically, it's more to take additional precaution. What if something unexpectedly happens, right? So in order to do this, you have to have certain basis of computation, and the recommended basis is using a value at risk. Yeah. So value at risk is the mathematical model, a calculation, a very complex form of calculation, right? But you are not required to know how to do it, but you just need to know that for every VAR calculation, you need two very important inputs, the time horizon and the confidence level, right? The higher the time horizon, the higher the confidence level, the bigger the unexpected loss. Means more capital is required. Yeah, okay, that's what it means. Okay, so that is what you just need to know for this part. Yeah, okay, don't need to go beyond that. Okay, right. So wrap it up. So far, what we have done, we have talked about what is the meaning of credit loss, right? Okay, the three factors. Credit loss can be due to so-called failure to comply with conditions, right? Potential exposure and potential losses. Yeah, so that these are the three. Then we also talk about expected loss, unexpected loss. How do we calculate the expected loss? What do we do, right, to prevent any risk? We also talk about unexpected loss. What is it? How it's being determined, right? And what do we do to reduce the risk, right? Additional capital required. Yeah. Okay. We will talk about that in the later part. How exactly the unexpected loss are being computed. Yeah. We'll talk about that. For now, just understand that. Yeah. Okay. So the next part is talking about credit risk framework. Like I told you, the framework. Okay. So what it means is when you lend money, right? When you lend money, so lend money is a very risky business, right? A risky business. So in order to minimize the risk, how would you structure your risk management system in relation to credit risk, right? Means how do you prevent, right, the bank from suffering all these credit losses? Yeah, right. So basically here, they are saying that, well, based on the framework, you should have a risk environment. For example, who is the people who govern that, as usual, board of governors, the risk management department, the head of the business unit, right? They will come up with policies and strategies for the people to comply to reduce risk. Yeah, example. So that's credit risk environment. Then you are talking about credit granting process. So if anybody applies for a loan, what would you look at? How do you go about assessing whether this customer deserves to be given the loan, right? Okay, deserve to be given. If he deserves, how much? What kind of loan to be given? Okay, right? And what are the collateral do we need if you need it? And how long do you need? So all these things is part of the credit granting process, right? And then once you have determined that, okay, we're going to give the loan, fine, okay, this is the loan we're going to give, this is so much, what's next? How to control the risk, right? How to prevent that the customer will not pay us back. What are the things that we need to do? Okay, for example, ask them to sign an agreement, put the collateral in, right? Then you will make sure that you have all the control procedure in place. Yeah, every year 6-month review, 1 year review, right? Pay a visit to the customer's office, etc., etc. So all these things will be in place. And then you have the last part, the credit administration, monitoring, and measurement process. Yeah. So that is more of the back office of credit. Yeah. Means, for example, if you approve the loan, then what are the things you need to do? You have to have the loan agreement, loan documentation. Get it signed by the customer. Get it stamped, for example. Right? So those are the documentation. Means you need a lawyer to look at all the terms and conditions to make sure that it complies with the rules. Right? You also have the monitoring. Means after giving the loan, see whether the customer perform what they're supposed to do. Remember the technical issues, right? Do they follow the covenants, etc., etc., right? And then you also have the measurement process. For example, how do you assess the risk? Okay. For example, what if they suffer this? How much loss will that be? So all these sort of things is quite straightforward. I won't go into detail. I just want you to spend your time on yourself to go through. Otherwise, very boring, right? For example, the corporate governance. Again, they talk about board of directors. What do? They set the policy, right? They determine how much risk the bank should take. And then they pass it to the senior management committee, which is basically also part of the board members or the senior management team to determine, right? How to implement it, including the risk management department, right? So once they're done, they pass it down to the credit risk management, corporate banking department, right? This one is basically to go and look for the loans and apply, and help the customer to apply for the loans, etc. Right? So once done, all the back office will do the work, administration, measurement, monitoring. Right? So this is a structure, right? Framework. Okay. So you can go through yourself. All mentioned here. What are the credit strategy, right? Policies. Okay. All the policies. So the process. Okay. Credit granting process, for example, like I do it just now, all right? You will, if the customer apply, you will look at the customer, assess the customer. Is the customer eligible? If eligible, how much, right? Okay, what kind of loans do we give? Under what type of conditions that we give? All mentioned here. Yeah. So I won't go into detail. Origination. What is origination? Origination is basically go and find customers and then structure the loans for them. Yeah. Okay. Right. So what are the so-called things that we need to do to determine whether this customer is suitable for the loan? We do the KYC. And when we do KYC, what do we look for? Yeah. So there's evaluation, right? What do we look into? Okay, right? And all this purpose, right? And when you repay, if your customer borrow the money, then you ask them, how do you repay? Where do you repay from? Of course, the customer can say two things. I can pay from the profit I earn, right? Right? Which is the internal, right? Or I can borrow money and pay you. I can borrow money and pay you. So how to borrow money? Either by issuing bonds or shares, right? So internal, external, right? Okay. So as far as you are concerned, you just have to do a due diligence whether they are telling the truth. Example, yeah. Okay. And then how do you ensure that the company that borrow money can pay back? So you must want to study the capability of the company to pay back. So you look at two areas. One is the business risk and one is the financial risk. What is the business risk? Look at the type of business they are doing. Okay, is the business good or not good, right? And financial means financially are they capable to pay, something like that. We will talk about that in deeper next chapter, right? Okay, so this is basically just a structure, collateral arrangement, good terms and conditions. What do you have? So when you look at approving in a borrower, what do you look at? You got the 5 C's. I mean, there are actually many methods that the bank use. Okay, I'm sure Maybank has their own methodology of how to look at customers and improve the chances of recovery. Every bank has their own. Okay, but these are very universal, standard criteria. Things like the 5 C's. So what are the 5 C's? The characteristic of the borrower, right? The capital of the borrower means how much capital do we have at the moment? Is the company strong enough? Something like that. Capacity. So if I lend you money, can you pay back? Right? Where do you get your money? Your business, for example. Conditions. Look at the terms and conditions. Can the customer meet those terms and conditions? And collateral. What can you offer as collateral? So this is called the 5 C's. I think this one very straightforward. You can go through yourself and know about it. Yeah? Okay? Right? So who are the one will look at all this? So you have the credit analyst, you have the special credit group, and the credit risk officer. So each one of them will have their own responsible, right, to look at all this approval. I won't go into detail. Administration, like I said just now, is more like make sure that the borrower comply with the borrowing conditions. Yeah, right. Also all this. Yeah. Then you monitor, right? You monitor to make sure that the customer is doing well, the customer can afford to pay, and not only that, look at the business, right? Not only you lend at the point of lending, you just accept it. No, you have to continuously looking at it. So I'm sure in Maybank, I don't know what's your Maybank procedures, but I believe that most customers will need to be reviewed on a yearly basis, yeah? At least once a year. Okay. Now, if any one of you know if your credit risk, maybe you should know, right? What is the frequency, right? But I believe frequency should be at least once a year. Some can be 6 months or something like that. Depends. Depends. Or maybe if the customer is it's too small, immaterial, maybe 3 years, 2 years, 3 years once. But if you're big, major, maybe 6 months a year, something like that. Yeah? And when you monitor, you look at what they do. Yeah. So I won't go into detail. All these are very dry stuff. Yeah. So make sure you go through yourself. Right. That's on chapter 5, introduction. Yeah. Now, chapter 6 here is also very much like chapter 5, but slightly different. Few things I just want to explain to you. For example, where does the risk come from? Okay, we know credit risk. We know credit risk, right? That, for example, customer don't pay us or they default on the terms and conditions, right? Okay, but where do we get all this problem from? The problem is when we actually do business. Yeah, we do business. So from the bank point of view, what are the business the bank do? Okay, so these are the type of business. Like for example, they give loans and advances. They also invest in securities. They have balance sheet exposure, off balance sheet exposure. What's off balance sheet exposure? For example, like you have a commitment to give a loan, but you have not given the loan yet. Means the loan will take place means you already got the loan, but the disbursement will only come in the future. Potential, that's called off balance sheet, right? Exposure. We'll talk about that in more detail. And then you have the derivative. Again, we will talk about derivative afterwards, yeah? Okay? Right? And then we also talk about, earlier, we already talked about the classification of loans into retail, sovereign, corporate, counterparty. But in this chapter, they will explain to you, say that, okay, if you are looking at the retail, if you're giving loans, what are the potential risk area you need to look at? Government, what are the potential? Although earlier I did say that when you lend money to government, there's no risk, yeah? Theoretically, yeah, no risk. But actually, when you lend money to government, you do have risk, especially a foreign government. You lend money to a foreign country government, there is always risk, yeah? Okay, we will talk about that further. Corporates, definitely, counterparties, it's got to do with derivative, yeah? Okay, and then the overview of credit risk, the source of credit risk. So this is more on the group portfolio basis. So let's do quickly here, right? So now, loans and advances, I don't think I need to explain to you what is loan advances. Means the minute you give a loan to a customer, definitely there is potential credit risk, right? I mean, just like we just talked about it. If you lend money to the customer may not pay you back or may not pay you back in full. Pay you back in full, right? So that is very obvious. Nothing to explain on that. Yeah? Okay? But over here, they say that loans risk can be minimized, right, by giving a secured loan. What do you mean by secure? Secure means basically you have something to hold in hand. Means we give a loan, the bank give a loan, but it's secure against, means there's something charged to the bank. So the bank has some kind of things to hold in hand. Okay? So what are things like collateral? Means let's say the bank give a housing loan to the customer, but the bank will hold the ownership of the house until the loan is being fully paid off. Right? For example, real estate, right? Property, right? If you let's say you take a car loan, right? I'm sure all of you do, hire purchase. So technically, the bank has a claim on the car until you fully pay off, right? Or you can also put in jewelries and art pieces as collateral, for example. Okay, right? Intangible assets. Just now I mentioned what's intangible. Just one of you said goodwill, right? Intangible can also be patent, trademark, copyrights. These are all intangible. It can also be used as collateral. But the question is, will you ever accept it or not? Right? Just as for example, M-Bank, right? If you read today's paper or yesterday's paper, right? M-Bank, they have to write off their goodwill a lot. Why? Because of the one MDB case. They have no more goodwill. All the goodwill has gone already, right? Because of the case. So you write off that. Okay? Right? And then all the investment instruments. So this one, I think I don't need to explain to you what are they, but they are also unsecured loan, or something called clean loan. Clean loan. Loan means no collateral. Clean. Right? Right? So some people say, that loan is clean. What do you mean? No collateral. So if it's no collateral, then how do you comfort yourself? So means you have to look at the person who borrowed the loan, how safe the person is. So you have to look at the credit worthiness of the person. Means you have to rely on the person's credit worthiness. Let's see, right? So I won't go into it, right? But bonds, okay. What is investment securities? What is credit risk? What is credit risk on investment securities? Right? Now, most of the investment securities, right? For example, now most of the time the bank don't buy shares, right? In Malaysia, very seldom the bank buy shares. Very seldom. Very seldom. Okay? Alright? And also very seldom that the bank invests in unit trust. Hardly. Okay? But it is very common that the bond, right? The bank will invest in bonds. Okay? Invest in bonds. Right? As you know, what is a bond? A bond is basically a loan, right? So if the bank buy a bond, they are basically lending money to the company that issued the bond, right? So just like any form of lending, if you buy the bond has a timeline, a maturity date, right? And on top of that, the bond also pay interest, right? They call that coupon, right? Pay coupon. So if you are investing in a bond, the bank invests in a bond, there are two types of payment that you can get. One is the coupon, one is the full repayment, right? For example, right? Okay, let's say this is the bank, right? So when they buy a bond, let's say this is a 3-year bond, 1, 2, 3, right? Okay. So let's say you buy the bond and the bond amount is 1,000, right? Okay, right? Just like loan, every year you will have interest of 40, right? This is, let's say, they got a coupon of 40, right? Okay. So what you do if you're at this point, you are currently down. So what it will be your risk? What is your credit risk? So your credit risk number 1 can be the 40, because every year you are expected to receive $40 as an interest payment or coupon payment, right? And if they may default on this, because let's say the business no good, they can't afford to pay the $40 in that year. So you may have a credit risk, right? So throughout this period, you will have credit risk on the coupon payment. But at the end of the 3 years, which they're supposed to repay this 1,000 to you, you also have a credit risk. So the minute you buy a bond, then your exposure will be 40, 40, 40, and 1,000. Yeah. So that is what we call credit risk in investment. Yeah. Shares, not so much credit risk. You know why? Because if you buy shares, then the company don't have to pay you back, right? If you buy the shares, that's your problem. You want money back, you're going to sell it to the market. Okay, you sell it to the market. The company is not going to pay you back, right? So in that case, if you buy share, it's most likely market risk rather than credit risk, right? So there won't be any credit risk there, right? Okay, that is how we look at it. Yeah. However, there is a credit risk if, for example, the customer may use the share as a form of collateral, right? Right? So if we lend money and the company give us shares in the form of collateral, so we use the share as a collateral. So if let's say customer default, we sell off the share, we sell at a loss. If the share price is low, we sell the shares. Right? It doesn't lose. We don't lose money, but we just sell the share. But the price we got is way below the amount we lend. So end of the day, our recovery rate will be low what we lend. So that is the credit risk. Okay, the recovered amount is less than what we supposed to get. Possible. That is on shares. But if you invest in share directly, there's no credit risk. Unlikely. Okay, so just to give you the idea, right? So I won't go into that. Off balance sheet, like I told you just now, is something that not happened yet, right? Now what is something not happened yet? For example, like overdraft account. Remember just now the example that we have, alright? Remember the example is, oh, they give you 2 million credit line. Means the bank agreed to give you 2 million loan, right? But until today, the customer has drawn down 1.5 million. Right? Draw down 1.5. Means another 500 million, but the 100 is unutilized. What do you mean unutilized? Means not used by the customer yet. Right? That amount, this amount can also be considered as credit risk. Right? Why? It may not happen today, but it can happen in the future. Now, when it happens in the future, we cannot prevent it. You know why? Because the bank has already committed to lend up to 2 million. Even though the customer need to draw down 1.5 million, the other half a million is something the bank has committed to lend. Means if the customer want it, they can have it. So that could be the exposure. But the only thing is whether do we want to provide the full exposure or not. That is the question. Yeah. Okay. So like for example, just now in the example, we only provide up to 75% of the exposure. I mean, we think that in the future they only use another 375,000, for example, right? So not the full amount. Yeah? But whatever say, the 500,000 is a credit risk to us. Yeah. That's why in this type of audit we charge commitment fee, right? Commitment fee. So we still charge the customer a fee, even though they don't use it. Why? Because that is a risk to us, right? We cannot give you, even though you don't use it, we cannot just let you run free with that. You still have to charge a commitment fee because on the bank's part, we have credit risk. Yeah, we have credit, so we must make them pay for it, commitment fees. Yeah, okay. So that's an example of overdraft, right? Commitment. Yeah. The other one is guarantee. So guarantee, I think I explained to you as guarantee, right? So if a bank gives guarantee to a customer, right? Okay. For example, okay. Right? So let's say this is customer, right? Customer borrow money from like CIMB, right? So CIMB give a loan to the customer, right? Okay. So what CIMB say, look, I don't trust the customer. So the customer comes to Maybank, asks Maybank to be the guarantor, right? Means in case that this customer didn't pay back to CIMB, then Maybank have to pay CIMB, right? Yeah. But that will only happen when the customer don't pay, right? But for now, what happened? As long as the customer have not default on the loan, right? Maybank don't have to do anything, right? Anything. But when it comes to credit risk, even though we don't have anything now, this is a risk to us, right? Even though we have not disbursed the money, we don't need to pay at the moment, but there is a potential that this can happen. So whether it happen or not doesn't matter. It's still a risk to us. So we have to make some kind of risk protection on that. Huh? So that is what I call guarantee. Huh? Okay? But the question is how much? Right? So in terms of risk management, then the next question you ask is, would it happen? If it happen, how much that we need to pay? We don't know, right? We don't know. Because this, like for example, this loan commitment and guarantee, it will only happen in the future, not today, right? So, will it happen? If it happen, how much do the bank have to pay out? We don't know, right? So, one of the things that we need to look at the degree of risk. So, we have to use our experience or some kind of policies to determine how much will be the exposure that we need to provide for, right? So for example, like guarantee and acceptance is a full risk. What do you mean by full risk? For example, like in this case, guarantor, we are giving a guarantee, right? So if the customer defaulted, if the let's say Maybank, CIMB give them 1 million loan, right? If the customer default 1 million, Maybank have to pay the entire 1 million. So it's a full risk, right? So whatever the customer cannot pay, we will have to pay the full amount. And as far as CIMB is concerned, they can claim the full amount from Maybank because that is the guarantee that we give them, right? Okay. So any amount that customer don't pay, CIMB can claim from Maybank. So Maybank, in that case, in the worst case scenario, they have to pay the entire amount. So that is what I call the full risk. Yeah, right? Okay. The other one is called medium risk. What is medium risk? Medium is something like documentary letter of credit, LC, right? LC is normally, for example, you use it for transaction goods, right? For example, if the customer import goods from overseas, once the good arrive, the bank will pay the money, right? On behalf of the customer, then only claim back from the customer, right? Now, so in this case, there's a goods. So if the customer don't pay you, you still can go after the goods. You can go and claim the goods and sell it off, right? Because you have the protection collateral, right? So what it means is, yes, you may lose some, but you don't lose all the money. Probably you lose a small portion because the goods that you're going to confiscate from the customer, you can sell off to the market for a certain price, you still can recover quite a substantial portion of it. That's called medium risk, yeah, right? Then the other is called low risk. What do you mean low risk? Low risk is something that the bank can decide at any moment in time to terminate it. If the minute the bank don't agree, cancel. Means no more responsibility. Just like, for example, overdraft. Back again, overdraft. So, for example, if the overdraft facility that you have, like in this case, okay, anything that you don't use, the bank has the right to cancel it. If that's the case, if that is under the contract, then the bank is okay. I don't want. I just cancel the 500,000. The customer cannot do anything. So that can reduce the risk to a very minimal amount. So it means as long as the bank has the right to cancel it, that is called a low risk. Okay. So this is something that you have to bear in mind. Right? Okay. Right. Now it's 5 o'clock now. Right? I better stop. But before I proceed to stop, okay, I just want to remind you what we will be doing tomorrow. Okay. Now, tomorrow I'm going to touch on this derivative. Now, it will take a while, right? Because this is one area where many people in the past have told me that there is a little bit challenge to understand. Yeah. So what it means is, before I explain about credit risk, I have to explain a little bit on derivative. What are these derivatives? Means we are going into investment. Yeah. So tomorrow I will start off by talking about derivative. What is forward contract? What is swap contract? What is option contract? Now, once you understand this contract, then you are able to see where the credit risk comes from. Yeah, right? Because it can be quite confusing. Yeah, all right. So I'll do that tomorrow morning. So, right now, what happens is, after that, I will not touch on this in detail later on. I mean tomorrow. For example, what are the areas that you need to look at? Retail, sovereign, corporate, counterparties. Yeah, but I will just touch on certain key areas, like for example, the right way and the wrong way risk. Okay, what are they? Yeah? Okay, right. So we will talk about that. The rest I will not cover it because I can leave it. But I will explain. I will just touch on it, and then I will explain it a bit short. Then I'll move on as to why I don't cover it. Then the heavy one tomorrow will be on the chapter 2 of the BIM2, where we look into the EL, just now the exposure expected loss. We talk about PD, LGD, and EAD, right? Tomorrow we will go into each and every single area. How do we determine PD? How do we get the PD rate, right? If it's 30%, why 30%? How do we arrive at that? That will involve some calculation and some numbers. Yeah, so that can be a bit challenging for some people, right? We also talk about LGD, basically on recovery rate. Yeah, recovery rate. And lastly, the EAD. EAD is very much similar to what we have discussed today. Not so much. Once we touch on derivative, then the EAD part will be covered. Yeah, right? And then there's other things that we do. So once we have done that, most likely it will take us towards the afternoon, right? And by late afternoon, we should finish this credit risk. But it will take a while. Yeah. So tomorrow could be a bit heavy for some of you, just let you know in advance, right? But those who have used the credit risk, they're not much of a problem. Yeah. Okay. So with that, I'm going to stop here. Okay. So I'm going to let you have a rest. I don't want to continue to bore you. I know some of you are pretty tired, right? So as usual, I will stay on for a short while. If any one of you have any questions, feel free to ask. Yeah. Okay. So I will let the rest of you go off if no question. So I'll see you back tomorrow at 9 a.m. Yeah, 9 a.m. So take a good rest, have a good dinner, and selamat malam. Yeah. All right. Cheers. Any questions? Yeah. Welcome. Thank you. Yeah. Fazila, Carol. Thank you.
Thank you. Good night.